Hello everyone, my name is Elliot Gu. I'm co-founder and chief analyst for Deep Dive Investing. Now the economy and the stock market move in cycles. Of course, there are no two cycles that are exactly alike, but there are patterns and similarities we can identify and monitor. So these cycles are definitely not random. Now understanding these cycles and how they work can certainly help you to avoid the pain of market downturns, and I'm talking about bear markets, which on average since 1937 have wiped out more than 35% of your stock market wealth. The last two have wiped out more than 50% of your stock market wealth. And just as important, these cycles can help point you towards specific market sectors and stocks to buy. So let me give you a more specific example. My research and the cycle indicators I follow in Deep Dive Investing suggest we're entering the latter stages of the current bull market and economic expansion. As many of you know, we recently hit new all-time highs in the S&P 500 here in late August. Now that doesn't mean the rally is going to end tomorrow. In fact, I don't think it will, and I've been saying that all year long. And it doesn't even mean that we'll see the stock market peak in the next 12 months. Now what it does mean is that market volatility is likely to pick up. I think interest rates are likely to rise further, and inflationary pressures are building. The big market correction that we saw back in January and February of this year is also typical late cycle action when we see the frequency and duration of market pullbacks pick up. So what stocks should you buy in a late cycle bull market when volatility is picking up? Look, one fundamental characteristic that tends to perform well at this stage of the cycle is something called quality. In fact, back on April 3rd, I ran a simple screen for stocks that meet this certain definition of quality. And I ended up with a list of 47 US stocks for further study. Out of those 47 stocks, I identified just two high quality names, and I rushed out an alert to deep dive readers to buy these stocks. And they're both in very different industry groups. The result, these two quality picks are up almost 10% and 16.6% respectively since recommendation, and that's much more than the broader market. And it's certainly not bad for a little over 4 months. And quality stocks aren't just for the late cycle bull markets. In fact, my research confirms that the top 10% of all S&P 500 stocks ranked on this simple metric have soared more than 2,000% in the past 25 years, which is more than double the return in the S&P 500. Listen, I just created a brief video presentation explaining quality and how it works, and I want to show you it completely free of charge right now. I'll even give you specifics of a few stocks that rank particularly well on this basis to follow. So keep watching this presentation through to the end. I promise I won't waste your time. Thanks again for watching. And keep your eyes in your email inbox over the next few days, because I'll be sending you links to additional free presentations and reports that could help you grow your wealth over this crucial stage of the market cycle. So here's to your wealth, and thanks again for listening.
Okay, so one of the most important things to understand here is how volatility behaves through a bull market cycle. And I like to call it the volatility smile. The reason is that early in a bull market, volatility tends to be quite high. In the middle of a bull market, volatility tends to fall. And at the end of a bull market, volatility tends to pick up again. So it's kind of shaped like a smile, high on both ends and low in the middle. And that's exactly what I think is going on right now with this stock market. But let's look at the last couple of bull cycles so I can illustrate what I'm talking about. The last bull market started way back in 2002, 2003 at the lows. The highs were in October 2007. And what we're looking at here on your screen right here is the VIX index. The VIX index is simply a measure of S&P 500 volatility priced into the options market. So it's a good metric for gauging how volatile stocks are. In other words, how much they have a tendency to move. And what you can see here is that volatility was very low in the area that's boxed in blue on your chart from late 2004 all the way up through the first 4 or 5 months of 2006. Then we saw a series of prominent spikes in the VIX starting in that summer. And let me go ahead and highlight those for you. We saw in around the middle of 2006 a big spike in volatility. In early 2007, we saw another big spike in volatility. Again here in June of 2007. And then coming off the ultimate highs for the S&P 500 in October, we saw another big spike in volatility. So we've had this period of low volatility in the middle of the bull market, late 2004 to the first half of 2006, and then a big spike in volatility, as you can see on this chart, towards the end of the bull market. Flipping back to the older bull market in the 1990s up until the 2000 top, the March 2000 top, what you can see here, volatility, again, priced by the VIX, very low in 1993, 1994, and 1995. That was the middle of that bull market. We saw a steady increase in volatility starting in 1996, including some big spikes at the end of 1997 and again towards the end of 1998. Volatility remained high from late 1998 all the way up until through 2000. And then we began a new bear market in 2000, as I said. So again, the volatility smile prevailed during the 1990s bull market. Well, here's what's going on today. Again, same chart for you, the VIX here. You can see that the VIX was at low levels in 2017. In fact, these were record low levels. Never before in history has the VIX closed under a level of 10. More times in 1 year than it did in 2017. In fact, about 80% of all VIX closes under 10 since the index was invented in 1990 happened last year. Incredible. Now again though, this year, the area I've boxed in blue here, we saw a big spike in VIX volatility up to over 35 in late January, early February when the market saw its correction. Yeah, the VIX has pulled back a little bit here, but it remains well above the levels we saw through much of 2017. And in fact, if you look at this pattern closely, you'll see it's very characteristic of what I showed you in those last couple of charts. You'll see these big spikes in volatility, and then it'll kind of come back down again. Then you'll see another big spike in volatility, then it'll kind of come back down again. But the general trend is a drift higher at the end of the bull market. I think that this is one of several signs I'm seeing that we're entering the latter stages of the bull market. I don't have time to go into all those signs in this short video, but we're seeing a pickup in inflation. We're seeing a pickup in stock market volatility. Two classic signs of a late cycle bull market. What works in a late cycle bull market? I'll tell you what works. What works is quality. Quality. Stocks, what do we mean by that? Well, stocks that tend to have above average profitability on measures like return on equity, ROE, and return on assets, ROA. I've put the definition of ROE and ROA up on the slide for you. These stocks have had a tendency to outperform the market during these periods of rising market volatility that tend to come at the end of a bull market. Now, it's important to remember that market volatility began to rise way back in 1996 during the big bull market of the 1990s, and the market didn't top out until 2000. In the last cycle, the market volatility began to rise in early 2006. We didn't see the stock market top out until the end of 2007. So this latter stage of the bull market doesn't mean that the top is in or a top is imminent. It just means we're getting closer to that top for the market, and that's why volatility is picking up. But the broader stock market can still go higher for a year, 2 years, even longer at times. But what tends to work, regardless of how long this stage lasts, is buying stocks which are above average profitability. Reason being, it makes a lot of sense if you think about it. Investors are going to gravitate towards companies that have strong, steady profitability when the going gets rough in the stock market. And the good thing, though, about buying quality is it always works to an extent. I looked at data going back over the last 25 years, and if you looked at if you ranked all the stocks in the S&P 500 by their three-year average return on equity, the top 10% of S&P 500 companies, rebalanced every quarter, returned over 2,000% over the last 25 years, versus the S&P 500 itself, only a 917.8% return. So more than double just by buying those stocks that have above average steady profitability over time. Here's what's even better. The holy grail of investing has always been higher returns with less risk. The standard deviation of the equal weighted S&P 500 is about 16% versus only 14.8% for S&P 500 high quality stocks according to this metric that I just outlined. So high quality stocks, lower risk, higher returns. As again, I say that's what every investor dreams of. So what's a company? A few months ago in early April, we did a screen for our deep dive investing service of the S&P 500 as well as some other large cap and small cap indices. And we came up with a list of about 47 companies that ranked well on various measures of profitability, various measures of quality. And our view was that this is a great starting point. We never go out there and just say, oh, because a company comes up on our screen, you should buy it. We use that as a starting point. We use that to develop a list of ideas that Roger and I then painstakingly go through and determine what names might be worth adding to the portfolio. We added a few names to the portfolio. One of the names that came up on our screen is Zoetis, symbol ZTS on the New York Stock Exchange. This is a healthcare company, but it's not the kind of healthcare company you might be used to. This is a veterinary healthcare company. This company makes drugs for dogs, cats, and also livestock animals, sheep, pigs, cattle, etc. This company makes medications for these markets. Most of their market, their largest market in the US, is companion animals or pets. One of their hottest ticket items right now are a whole group of dermatology products aimed at dogs. Many different breeds of dogs have problems with itchy skin, with inflamed skin, and they've developed a whole series of drugs to target that. The beauty of the veterinary healthcare market versus the human healthcare market is there are a couple of things. One of them is there's less regulation. Obviously, a new drug for the human market has to go through many, many, many layers of trials. It has to pass through the FDA before it's approved for use. Most pet healthcare drugs are simply human drugs that are adapted for the pet market. So there's a lot less R&D out there, and there's a lot less regulation because there are already drugs that have been approved for the human market that are being blended for the veterinary market. So it's a very high margin business because you don't have all that upfront R&D for creating these drugs. The other thing about the pet healthcare market, the veterinary healthcare market, many of you probably have pets, and you go to the veterinarian and you go to pay at the end of the veterinarian visit. What do? You whip out your credit card, right? And you pay for this for the visit for your dog or for your cat. You don't file an insurance claim. Probably there are pet insurance policies, but most people don't. More than 90% of transactions are cash transactions, which means there's no insurance reimbursement. There's no Medicare for dogs and cats. It's a cash-based transaction, a very highly profitable business. Zoetis has well above average profitability to the S&P 500, as I'll show you in a moment. And from the time it started popping up on our screens earlier this year, Zoetis has actually seen some nice gains, over about 13% at the time of this recording. Here's a look at Zoetis profitability versus the S&P on two different metrics. The green line on your chart is operating margin, profit, basically a measure of profitability. The orange line is return on equity. And on the top you have Zoetis, on the bottom you have the S&P 500. Notice the levels here. The return on equity for Zoetis is over 60%. For the S&P 500, it's about 15%. The profit margin, the operating margin for Zoetis right now, 34% nearly, 33.85%. For the S&P 500, 13.8%. So almost 3 times lower. Also notice the pattern here. The profitability for the S&P 500 really shrank from late 2014 through early 2016 when the U.S. economy saw a big soft patch. But look at what the case is for Zoetis here. You can see that we did see the profitability dip a little bit, but for the most part, profitability is pretty steady for Zoetis, while in the S&P 500, you saw kind of this big dip here in 2016 when the economy softened, and then a rally when the economy strengthened again in 2017 and 2018. So that's a look at quality. I think it's a metric that you should keep an eye on, especially at this stage of the bull market, and I think it can put a little extra money in your portfolio, a little extra money in your brokerage account for you.